Listen closely, because moments like this don't announce themselves twice. History rarely knocks politely, it kicks the door in. And right now, while most of the world is distracted by headlines and hype, a quiet industrial decision has just sent shockwaves through the global commodity system. It's already over. Tesla's switch to a 48-volt architecture didn't just change automotive wiring. It exposed a silver shortage so massive it measures in billions of ounces, and almost no one is prepared for what comes next. For decades, silver has been treated like a side character in the economic story. Undervalued, underestimated, mispriced. Yet silver is not just a metal, it is an enabler of modern civilization. Every circuit, every conductor, every high-efficiency electrical system leans on it. And when Tesla, the most influential EV manufacturer on the planet, made the move from 12-volt to 48-volt systems, it wasn't a design tweak. It was a declaration of the future. Higher voltage means lower current, less heat, more efficiency, and far more silver embedded deep inside every vehicle produced at scale. Think about the ripple effect. Tesla doesn't move alone. When Tesla shifts, the entire auto industry follows. Legacy manufacturers, EV startups, commercial fleets, autonomous platforms, all of them now face the same engineering reality. And that reality demands more silver per unit at a time when global mine supply is already strained, recycling is insufficient, and above, ground inventories are thinner than most people realize. This isn't speculation. This is math. Demand has structurally changed, and supply simply cannot respond fast enough. Here's the hook: most people miss silver is consumed, not just stored. Unlike gold, much of silver is used in ways that are uneconomical to recover. Once it's in electronics, it's gone. That means every new 48-volt system quietly removes silver from the market forever. Multiply that by millions of vehicles per year, then add charging infrastructure, power management systems, AI hardware, solar grids, and defense applications. Suddenly, a 1 billion ounce shortage doesn't sound dramatic, it sounds conservative. This is how paradigm shifts happen. Not with fireworks, but with engineering decisions buried in technical documents. The market always reacts late. First comes disbelief, then denial, then urgency, and finally panic. We are somewhere between disbelief and denial right now. Prices still whisper while fundamentals are screaming. But make no mistake, the moment industrial buyers are forced to compete with investors for physical supply, the rules change overnight. And here's where motivation meets reality. Opportunity doesn't wait for consensus. It rewards preparation. The people who win in moments like this are not the loudest, not the fastest, but the ones who understood the signal before it became noise. Silver is no longer just a hedge or a commodity, it's a strategic material. Governments know it. Corporations are starting to feel it. The only question is whether individuals will recognize it in time. 1. Structural demand shock from technological transition. Tesla's shift from 12-volt to 48-volt electrical architecture represents a structural, not cyclical, increase in silver demand. Higher voltage systems require thicker conductors, enhanced power distribution modules, and more advanced electronic components, all of which intensify silver usage per vehicle. Once the standard is adopted, it becomes irreversible across the industry, permanently resetting baseline demand higher. 2. Industry-wide adoption multiplier effect. Tesla functions as a technology leader rather than a standalone manufacturer. When Tesla standardizes a platform, suppliers, competitors, and regulators adapt accordingly. As other automakers migrate to 48-volt systems to remain competitive and compliant, silver demand scales exponentially across global vehicle production, magnifying the initial impact far beyond Tesla's own output. 3. Inelastic and constrained supply response. Silver supply is characterized by long lead times, declining ore grades, and limited primary silver mining. The majority of silver production is a byproduct of base metal mining, making supply relatively inelastic to price increases. Even sustained higher prices cannot quickly translate into higher output, creating persistent supply deficits under rising industrial demand. 4. Irreversible consumption and inventory depletion. Unlike monetary metals, silver used in electronics is largely unrecoverable at scale. Each unit embedded in vehicles, power electronics, and infrastructure is effectively removed from above ground inventories. This ongoing consumption accelerates physical tightness in the market, reducing available buffers and increasing sensitivity to demand shocks. 5. Price discovery failure in paper-dominated markets. Current silver pricing reflects paper market dynamics rather than physical scarcity. Futures contracts and derivative exposure suppress price signals despite growing physical deficits. As industrial users begin securing long-term supply and stockpiling inventory, the disconnect between paper pricing and real-world availability becomes unsustainable, forcing rapid price readjustment. 6. Strategic repricing of silver as a critical input. The 48-volt transition reframes silver from a discretionary industrial input into a strategic resource essential to electrification, automation, and energy efficiency. This transition drives a long-term repricing process where silver's value increasingly reflects its functional necessity rather than historical trading ranges, signaling a fundamental shift in how the market values the metal. What looks like a simple engineering upgrade is, in economic terms, a textbook example of a structural demand shock, one that permanently alters the consumption curve rather than temporarily shifting it. The transition from 12-volt to 48-volt electrical systems fundamentally changes how power is generated, distributed, and managed inside modern vehicles. Higher voltage reduces current losses, improves efficiency, and enables a new class of electronically controlled components. But hidden beneath those efficiency gains is a less visible reality. The material intensity of the system rises, and silver becomes increasingly non-negotiable. This is not a marginal increase in usage. It is a redesign of the electrical backbone, embedding more silver into every vehicle as a core requirement rather than an optional input. Here's the hook most market participants miss. Once a technological standard is upgraded, demand does not revert. Automakers cannot simply roll back to legacy architectures without sacrificing performance, safety, and regulatory compliance. A 48-volt platform locks in higher silver consumption per unit for the life of that platform and every generation that follows. From an economic standpoint, this converts silver demand from discretionary to compulsory. Each vehicle rolling off the assembly line now carries a larger, unavoidable silver footprint, and that footprint compounds as production volumes scale globally. What makes this shift especially powerful is its timing. The automotive sector is already undergoing simultaneous transitions: electrification, automation, and digitalization, each of which independently increases silver demand. The move to 48-volt systems does not occur in isolation. It stacks on top of existing demand pressures. Power electronics, advanced sensors, control modules, and safety systems all depend on silver's unmatched conductivity and reliability. As voltage rises, performance tolerances tighten, leaving few viable substitutes. Economically, this creates a demand curve that is both steeper and less elastic, meaning higher prices do little to reduce consumption because the metal is functionally irreplaceable. Another critical hook lies in scale. Even modest increases in silver usage per vehicle become massive when multiplied across tens of millions of units annually. This is where linear thinking fails. Markets tend to underestimate cumulative demand effects, focusing on single unit changes instead of aggregate consumption. Yet it is precisely this aggregation that transforms a technical adjustment into a macroeconomic force. The result is a sustained upward pressure on demand that persists across business cycles, recessions, and policy shifts. Most importantly, this demand shock is silent. It doesn't arrive with headlines or emergency announcements. It is embedded in design standards, supplier contracts, and manufacturing processes that will remain in place for decades. By the time price signals fully reflect this reality, the adjustment will already be complete. In economic terms, the demand curve has already moved, and the market is only beginning to notice. What transforms a single corporate decision into a macroeconomic event is not scale alone, but imitation. Tesla operates less like a conventional automaker and more like a technological standard setter, and history shows that when a dominant innovator rewrites the rulebook, the rest of the industry follows whether it wants to or not. The shift to a 48-volt electrical architecture is not a feature competitors can ignore or selectively adopt. It establishes a new baseline for efficiency, performance, and system integration, forcing suppliers, manufacturers, and regulators into alignment. This is where the multiplier effect begins, and it is far more powerful than most demand forecasts account for. The first layer of this effect emerges within the supply chain. Tier 1 and Tier 2 suppliers cannot economically maintain parallel production systems for legacy and next-generation platforms at scale. Once Tesla commits to 48-volt systems, suppliers retool, redesign, and renegotiate contracts around that standard. Those same suppliers serve multiple automakers, meaning the upgraded architecture propagates rapidly across brands, models, and markets. Silver demand therefore expands not linearly with Tesla's output, but exponentially through shared manufacturing ecosystems. This is the hook. Tesla's production numbers matter far less than Tesla's influence. The second layer unfolds through competitive pressure. Automakers competing in the EV and hybrid markets are locked in a performance race defined by efficiency, range, and system reliability. A 48-volt platform enables lighter wiring, more advanced power management, and improved integration of digital systems, advantages that quickly become table stakes rather than differentiators. Once one major player adopts the standard, others must follow or risk falling behind. Economically, this converts what appears to be a voluntary upgrade into a compulsory industry-wide shift, accelerating adoption timelines and compressing demand into a shorter window. The third layer is regulatory and infrastructural alignment. As higher voltage systems demonstrate superior efficiency and safety, they influence regulatory frameworks and engineering best practices. Standards bodies, safety regulators, and fleet operators begin to assume 48-volt compatibility as a baseline requirement. Commercial fleets, autonomous platforms, and public sector procurement amplify this effect, extending silver-intensive systems beyond consumer vehicles into logistics, transportation, and industrial mobility. Demand multiplies across sectors that were never part of the original calculation. The critical insight is that this is not a one-time surge but a cascading process. Each adopter pulls the next into the system, reinforcing demand at every stage. Markets often underestimate this type of diffusion because it unfolds quietly, embedded in contracts and design decisions rather than headlines. Yet by the time adoption becomes visible in aggregate production data, the structural demand increase is already locked in. The multiplier has already done its work, and silver demand has expanded far beyond the initial trigger point. Rising demand alone does not create a supply crisis unless it collides with a system that cannot respond, and silver's supply structure is uniquely vulnerable to exactly this kind of pressure. Unlike commodities where higher prices quickly incentivize new production, silver operates within a constrained and inflexible framework. The majority of global silver output is not produced from primary silver mines, but as a byproduct of copper, zinc, lead, and gold operations. This means silver supply is dictated less by its own price and more by the economics of entirely different metals. Even a dramatic increase in silver prices does not automatically translate into higher production, a reality that fundamentally breaks the traditional supply response model most markets rely on. Here's the hook that reshapes the conversation. Silver cannot be turned on when it is needed most. Developing new mines requires years of exploration, permitting, financing, and construction, all while facing rising environmental, regulatory, and political barriers. At the same time, ore grades across existing mines continue to decline, forcing producers to process more material to extract the same amount of silver. This increases costs, energy use, and operational complexity, further limiting the industry's ability to scale output quickly. Economically, this creates a supply curve that is both steep and slow-moving, incapable of meeting sudden or sustained demand increases. Compounding this rigidity is chronic underinvestment. For years, silver prices have failed to reflect its growing industrial importance, discouraging capital expenditure in exploration and development. Mining companies allocate resources where returns are clearer and faster, leaving silver production capacity stagnant. This underinvestment becomes most visible precisely when demand accelerates, revealing a structural gap between what the market needs and what the industry can deliver. The result is not a temporary shortage, but a persistent deficit that feeds on itself. Recycling, often cited as a pressure valve, offers limited relief. Much of the silver used in electronics, power systems, and advanced technologies is dispersed in small quantities across complex products, making recovery economically inefficient. As technological complexity increases, recyclability declines, further tightening supply. This means that above-ground stockpiles, rather than production, increasingly determine market balance. Once those inventories are drawn down, there is no rapid mechanism to replenish them. The deeper economic risk lies in timing. Supply responds slowly, while demand driven by technological mandates and industrial standards moves quickly and decisively. This mismatch creates periods of extreme tightness, where small disruptions can have outsized effects on availability and pricing. Labor issues, geopolitical tensions, energy constraints, or environmental regulations can all exacerbate shortages in a system with no slack. By the time higher prices send a clear signal, the physical metal is already committed elsewhere. This is the defining vulnerability of the silver market. It is not the absolute size of demand that matters most, but the inability of supply to adapt when demand structurally shifts. When a market loses flexibility, volatility becomes inevitable, and scarcity becomes structural rather than cyclical. One of the most misunderstood dynamics in the silver market is the difference between temporary use and permanent loss, and this is where traditional supply and demand models quietly break down. Silver is not merely stored and reused, it is consumed in ways that permanently remove it from circulation. When silver is embedded into electrical contacts, power management systems, sensors, and advanced electronics, it is dispersed in microscopic quantities across complex products. From an economic standpoint, this transforms silver from a recyclable commodity into a depleting resource. Once installed, it effectively exits the market, shrinking the pool of available above ground inventory with every new unit produced. Here's the hook that changes the perspective: silver demand doesn't just increase, it accumulates. Each new vehicle, device, or system does not replace prior consumption. It adds to a growing stock of irretrievable metal. Unlike oil, which is burned once, or copper, which is frequently recovered, silver sits in a gray zone where recovery is technically possible but economically irrational at scale. As products become more complex and miniaturized, the cost of extraction exceeds the value of the metal itself. This means that rising industrial demand does not cycle silver back into the supply chain, it quietly drains it. The economic consequence is inventory depletion, not production shortfall. Markets often assume that above-ground silver stocks provide a buffer against supply disruptions, but this buffer is steadily eroding. Each year of industrial growth draws down inventories that took decades to accumulate. The more technologically advanced the economy becomes, the faster this depletion accelerates. This is especially critical in sectors like automotive, electrification, and power systems, where silver is not optional but essential for performance, safety, and reliability. What makes this dynamic especially powerful is its invisibility. There are no dramatic announcements when inventories decline. The drawdown occurs silently through manufacturing cycles, supplier contracts, and infrastructure buildouts. By the time shortages become visible, the metal is already embedded in products scattered across the global economy. At that point, price signals no longer function as gentle incentives, they become rationing mechanisms. Another overlooked hook lies in substitution limits. When silver is consumed in high-performance applications, there are few viable alternatives without compromising efficiency or durability. This locks in consumption even as prices rise, further accelerating inventory depletion. Economically, this creates a feedback loop where higher prices fail to meaningfully reduce demand, while supply remains unable to recover lost material. The long-term implication is a market increasingly driven by scarcity rather than flow. When inventories fall below critical thresholds, availability becomes more important than price. Industrial buyers shift from just-in-time purchasing to stockpiling behavior, intensifying competition for physical metal. At that stage, the defining factor is not how much silver is mined each year, but how much remains accessible at all. One of the most critical distortions in the silver market lies not in geology or industrial demand, but in how price is discovered. Silver trades in a financial ecosystem dominated by paper instruments, futures contracts, options, and unallocated accounts that bear little relationship to the availability of physical metal. These mechanisms were designed to provide liquidity and hedging efficiency, yet over time they have created a pricing structure where volume overwhelms reality. The result is a market price that reflects leverage and sentiment more than physical scarcity, masking growing supply deficits beneath a surface of apparent stability. Here's the hook most investors overlook: paper silver can be created instantly, but physical silver cannot. A futures contract requires no immediate delivery, no mining, and no refining. This allows vast quantities of synthetic supply to enter the market, dampening price signals even as real-world inventories tighten. Economically, this suppresses the feedback loop that would normally encourage conservation, substitution, or new production. Instead of rising to ration scarce resources, prices remain artificially anchored until physical demand forces a reckoning. This disconnect becomes most dangerous during periods of structural demand growth. Industrial consumers do not operate on paper assumptions, they require metal in hand. As long-term supply contracts come up for renewal and spot availability tightens, manufacturers are forced to look beyond benchmark prices and secure physical silver directly. When enough buyers do this simultaneously, paper markets lose their ability to dictate reality. At that point, Pricing power shifts abruptly from financial intermediaries to those who control deliverable metal. Another overlooked hook is the asymmetry of risk. Paper markets assume that only a small percentage of contracts will ever stand for delivery, an assumption that holds only in times of surplus. When inventories shrink and confidence weakens, even a modest increase in delivery requests can overwhelm available stock. This is not a gradual adjustment, it is a nonlinear event. Prices do not drift upward. They gap higher as the market rushes to reconcile contracts with metal that may no longer exist in sufficient quantity. The economic consequences extend beyond price volatility. A failure in price discovery erodes trust in the market itself. Producers hesitate to invest, uncertain whether prices reflect real demand. Consumers delay procurement, assuming availability that may not be there when needed. This misallocation of capital deepens the imbalance, ensuring that when correction finally occurs, it is sharper and more disruptive than it otherwise would have been. What makes this moment particularly fragile is the growing divergence between financial abundance and physical scarcity. As long as paper markets dominate, the illusion of supply persists. But industrial demand does not trade illusions. When the need for physical silver collides with a market structured around promises rather than metal, the adjustment is swift and unforgiving. In such environments, price no longer serves as a guide. It becomes a consequence of a system forced back into alignment with reality. What ultimately changes a market is not scarcity alone, but recognition. Silver is in the early stages of a strategic reclassification, moving from a traditionally undervalued industrial input to a critical resource embedded at the heart of modern infrastructure. As technologies converge around electrification, automation, artificial intelligence, and energy efficiency, silver's role becomes less optional and more foundational. This shift forces a repricing process that is economic rather than speculative, driven by necessity instead of narrative. The metal is no longer valued solely on historical trading ranges or legacy investment frameworks, but on its functional importance to systems that cannot operate without it. Here's the hook that reframes the entire discussion. When a material becomes critical, price becomes secondary to access. Governments, corporations, and defense sectors do not compete on spot prices. When supply security is at stake, they compete on availability. This changes buyer behavior dramatically. Long-term contracts replace spot purchases, inventories replace just-in-time logistics, and stockpiling becomes rational rather than precautionary. These behaviors remove even more metal from the open market, accelerating tightness and reinforcing the repricing cycle. The economic logic mirrors what has already occurred in other strategic materials. Once policymakers and industrial planners recognize supply vulnerability, silver moves from the category of commodity to that of strategic input. This invites intervention through incentives, strategic reserves, export controls, and preferential access agreements. Such measures are not designed to stabilize prices for investors, but to protect industrial continuity. The market impact is profound because it segments supply into strategic and non-strategic channels, reducing freely traded volumes and increasing competition for what remains. Another overlooked hook is how this reclassification alters investment behavior. Capital flows begin to follow industrial necessity rather than cyclical momentum. Mining projects previously considered marginal become viable, not because prices spike temporarily, but because long-term demand visibility improves. At the same time, the long development timelines of new supply mean that repricing leads production, not the other way around. Prices adjust first to reflect scarcity and strategic value, while supply lags years behind. This process also reshapes substitution economics. When silver is strategically essential, substitution is no longer evaluated purely on cost, but on performance risk, reliability, and national resilience. Inferior alternatives become unacceptable, even if cheaper, locking in demand at higher price levels. Economically, this raises the floor of silver's valuation, reducing the likelihood of deep price retracements once repricing takes hold. The most important shift is psychological, but grounded in economics. Markets that once viewed silver as abundant and flexible begin to treat it as scarce and indispensable. That change in perception alters every transaction, from procurement decisions to policy frameworks. Once silver crosses that threshold, its value is no longer debated in terms of what it used to cost, but in terms of what it would cost to do without it. So as we close, remember this: Tesla didn't just redesign a vehicle system, it exposed a fragile supply chain that the world depends on. The shortage isn't coming, it's already here. The shift is already locked in. And history will look back at this moment as the point when silver stopped being ignored and started being impossible to replace. The only thing left to decide is which side of that realization you stand on before the rest of the world finally catches up.